Hello and welcome everybody. Happy Friday, welcome to the end of another week and another Sectors Made Simple webinar. I'm happy to be here with you all today to look and answer a question that we've been asking quite a bit recently. Are we in a recession? If we're not in a recession, are we going to be? There's a lot of different ways that we can answer this question. And we've taken a look at some of these ways that we can answer it in Sectors Made Simple members webinars, where we've looked at sector rotation using the matrix, the Sectors Made Simple matrix, as our way of seeing who are the market leaders right now. The matrix is incredibly useful at helping us to understand the market cycle of the stock market. But there's also the economic side of all of this, the economic cycle. And while we've talked about how the market cycle and economic cycle relate to each other, we've never just looked at the economic cycle. So today, I want to do that. I want to talk about 3 different ways that we can look at the economic cycle and see what's the economic side of things saying for are we in a recession or is a recession coming up? Now, unfortunately, if you're watching this webinar to try and get some answer, I'm not a fortune teller. Nothing is ever for certain, and we never really know what's going to happen until it happens. So the goal of today is not to tell you what you should think is going to happen. It's to give some additional information. And I'm also going to give some dates of when we'll get new information to help us make a more educated decision. Sound good? If it does, stick around and let's start off by going through today's presentation. So, we're going to start off with the disclaimer. I kind of said a couple of words about it, but just remember that what I share here is very much meant to be an educational resource. It's not telling you how to think, it's not telling you what you should buy or what you should sell. It's just a way of taking information that I find or that I find useful and sharing it with all of you so that we can all make a more educated decision. Past results can never guarantee future performance. So when we're looking at historical charts, remember that they are historical and you never really know what's going to happen in the future. Alrighty, let's get into the goals for today's webinar. Like I mentioned before, in our members webinars for Sectors Made Simple subscribers, we've talked quite a bit about the current state of sector rotation. This idea that there are different sectors that are leaders or laggards in any stage of the market. Now, we can kind of predict where that cycle is going to go based on what sectors are leaders right now and what sectors are showing signs of leadership in the future. And we've used the matrix, a way of comparing all of the different sectors against each other in one picture to do this. And it has been incredibly useful for us to understand where in this cycle we are. But the vast majority of our analysis for the matrix has looked only at the market cycle, not at the economic cycle. So today I want to look beyond the stock market. We are not even going to talk about stocks today. All we're going to talk about is the economy and some different ideas and securities in the economy that we can look at to try and understand the big question everyone's asking. Are we in a recession? And if we're not in a recession, is a recession coming soon? Let's first start off by talking about what this economic cycle actually is. The economic cycle is a very well-established trend in economics, that the economy always moves through time in a big cycle. GDP historically has trended upward, and if we just took an average GDP over time, it would be a straight line going up. But that's not the life we live. We don't live this very straight line to success. Instead, we go above the line, below the line, above, below, below, all that. That is the economic cycle. It is this idea that there are periods of huge growth and periods of less growth. And we can try and understand the cycle by looking back in time and seeing how the cycle has played out in the past. So this cycle, if we looked at the past 170 years, keep in mind this number ends in 2009. We've had one more recession since then, but it was the shortest recession in history, in just 2 months in April. But prior to that recession, the average cycle, we're talking goods and bads included, is 4.7 years. But as I said before, we can't always be in a period of growth. There are sometimes periods where we're growing and sometimes periods where we're shrinking a little bit. It's kind of like life, right? But we can look at the economic cycle in 4 major parts: recovery, expansion, or leading up to a peak. After it peaks, it goes and starts slowing down. Then we hit a recession or a trough. Now this trough, when I say the word recession, I don't just mean a recession. It is not this black and white, is a recession, is not a recession kind of thing. There have been periods that we have called a recession. Periods where we've called a recession the Great Recession. And periods where a recession goes a little bit deeper and it goes into a depression. So this idea of this trough is not a always black and white thing. It is very much a scale of how deep into a recession do we go? Do we even hit a recession? Or is there just pullback in the market? Let's explore this a little bit more. Instead of just naming what these things are, let's talk about what it would be like to live through them. What is happening to us and to the world around us as we go through this cycle? Let's start off with expansion. Expansion is the period of time where GDP grows 2 quarters in a row. Now, in these periods, money's cheap. Money's available. Everyone has money. So if you wanted to go and buy a house, easy. It's really easy to borrow money, and it's really cheap to borrow that money. Because money is cheap, consumer spending is high. We want to go and blow all that extra money that we have. And because spending is high, companies are making a lot of money. Those companies are growing and expanding and hiring new people. Unemployment's low and everything's great. The tank is clean. We're all happy. But this consumer spending thing is fun, but also dangerous. Because as we continue spending more and more and more, it drives up the cost of things. Supply and demand is a very simple economic idea. When we have a lot of money to spend, we start spending it. So our demand goes up. Supply needs to go up as well, and it might not go up as quickly as our demand would. Additionally, this is going to cause inflation. When there's a lot of money being thrown into the economy, the value of a dollar starts to go down. It starts to go down pretty quickly. One way that we can measure this inflation or how expensive things are is by the CPI, or Consumer Price Index. It's this idea of looking at many different things that urban consumers, people that live in major cities or near major cities, what they are paying to live. So when this starts to go up, it can only go up so much before us having a little bit of extra spending cash becomes, all right, that extra spending cash is going now to just the things that I need. It's so expensive to buy the things that I need that I don't have that extra spending cash anymore. Another way we can think about it is the cost of things grows faster than our wages do. Everyone thinks that you get a raise every year. That's great, but part of that raise also goes to combating inflation. If you don't get a raise in a year, you're technically making less money because the value of that dollar that you were earning doesn't buy you as much anymore. This is where things start to get unsustainable. We can't keep going with this forever. So this leads to consumers starting to cut back on their spending. Oh, hello Tech. Thanks for joining us today. It's great to see you again. When we start to cut down on our spending, businesses don't make as much money. When businesses don't make as much money, this is where a cycle starts to begin, of where this expansion slows, and also where we start to see the beginnings of a bear market. We then enter a period of slowdown, or you might see it called contraction. During this period, the price of things might continue to go up. Businesses are starting to see their profits decline, so they continue increasing prices to try and combat that. Now, we will in this period start to see GDP growth slow. Not stop, not reverse, but just slow. And this is where that name, that slowdown, comes from. The economy is slowing down. Costs start to outpace how much money we make. When we're not making as much money, but we still need to spend a lot of money to live, we're going to be spending less on the things that we want to spend money on and spend more on the things we need to spend money on. This causes businesses to start losing revenue. When they start to lose revenue and they can't increase costs anymore because people won't buy, they will start to cut salaries. They'll pay people less. They might start firing people. And of course, when people are now making less money or are making no money, that decreases their ability to spend. Now, many of us spend money that we have to spend, but anyone that has any sort of line of credit cards, home loans, auto loans, anything that is debt, there's now a risk that they are not making enough money to pay off those debts and that interest. So as this risk of what's called defaulting or not being able to pay back loans increases, it becomes more expensive to borrow money. Banks are less likely to lend money to people if they're not as likely to be able to pay it back. If there's that risk, remember, risk and reward are sadly two very related things. We think of risk versus reward, but they're two sides of the same coin. If a bank has more risk in giving you money, they want more reward. So if a bank thinks that you have, this is, by the way, just an example, if they think you have a 5% chance of not paying back your money, they're going to charge you 10%. They want to make sure they can make a profit on you. So the rate of loans, or the interest rate for loans, goes up. Not just for people like you or me, but also for Juan de los Palotes Incorporated down the street. Companies. All money becomes more expensive to borrow. Now, in this period, we start to talk about this idea that we'll talk a lot about today. Bond interest rates. These bond rates will begin to shift in this period because we'll start to see short-term securities outpace long-term securities. If that means nothing or if that sounds like Swahili to you, bear with me, we'll talk about it in more detail. Also, I've got some nice pictures to go along with the explanations. I like graphs. I hope you like graphs too, because we're going to look at a decent bit of graphs today. They're pretty, I promise. But first, let's finish up with our cycle so we can go full circle and then we can get into the real meat and potatoes of today. Let's now talk about the part that no one wants to talk about or think about, a recession. A recession is, in part, defined by a period of 2 consecutive quarters of GDP losses. If a person knows nothing about a recession and you ask them what makes a recession, this is probably going to be the answer that people tell you. A recession is a period where GDP declines by 2 consecutive quarters. It's what's in textbooks, it's what's known, if you only had one number to look at, most people are going to look at GDP. But let's talk about what it is like in this recessionary period. In this period, production for companies continues to fall. People aren't buying stuff, so companies are going to produce less stuff so that they can keep prices up. They're going to not want to hire as much. In fact, they're going to start firing people. And spending hits a low for this cycle. As our spending hits bottom, costs will finally decrease, which will drive down inflation and the CPI. So this is where we'll actually see those prices start to get back into control. If you've been with me for the past couple of webinars where we've talked about this big R word, recession, I've mentioned many times that recessions are part of the cycle, but are also healthy for long-term economic growth. Because it is a way, not the only way, but a way for inflation and cost of everything to drop back down to meet what consumers can spend. Now, this period lasts, on average, depending on what time frame you look at. If you don't include the current 2020 recession, or the most recent 2020 recession, it's going to be 17.6 months. If you do include it, it goes down to like 15.4, I think. Somewhere in the 15 range. But do remember something. Remember what I said before. This cycle, over the past 170 years, has lasted an average of 4.7 years. What that means is that we spend 2 times more of our time in a growing economy than we do a recessionary economy. If nothing more, that should be a little bit of comfort, where we spend less time in a recession and we always rise to new highs. We have always seen bear markets and recessions recover and have always grown past them. If you ever look at an economic cycle, I want to just Google it and show you something. This one goes up over time, 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 up over time. You see a trend. This is not me just trying to give you some good news so that we can all sleep happy tonight. This is economics. We don't fall as far as we've grown. That's a very, very comforting thing in the long term. But we don't just care about long term. What we care about is what do we do short term and what the heck is our current short term. Sadly, I don't have an answer for you. No one has an answer for you because no one person knows what's happened, but also what's going to happen. So the best we can do is understand that there's a lot of unknowns. There's a lot of things that we just have no freaking idea about. So the best we can do is try and look at what information there is today. Because if you just ask people on the street, I'm not talking economists, I'm not talking investors, I'm talking Juan de los Palotes and Maria de las Flores down the street. If you ask the average person, are we in a recession? They're not going to think, all right, a GDP, what's the current GDP? No, they're going to tell you, all right, I feel like my money is not getting me as far. I'm not making enough money to be saving, investing, and living all at once. That's in part what leads to a recession, is that feeling. And having that feeling get worse and worse until it starts to get better and better. If you ask the average person that doesn't think about economics, doesn't look at GDP, they are probably going to tell you that they feel like we've been in a recession for 6 months. Many, even economists, think that we have been in a recession for 6 months. But many others feel that we are not in a recession, but one is right around the corner. They think that we are in that late expansion, hit peak, and are starting to dip down into that recessionary period. Now again, in previous webinars, mainly members webinars, we've taken a look at the stock market, at sectors, and at sector rotation to see where in this cycle we are. There is this known cycle that the market leads the economy. We will see changes in the market cycle before we will see changes in the economic cycle. And we've looked at sector rotation and seen who historically has been leaders in what periods, who are our leaders today, who might be our leaders tomorrow. And we found some surprising results where the matrix matched up almost perfectly with what sectors we would expect to be leaders and what sectors we would expect to be growing and falling in these different points of this market cycle. If you are a Sectors Made Simple subscriber, please go and check out that webinar. You will find it very, very interesting. But today, I want to look beyond just the stock market. I want to look at information that we all have access to, which is a lot of economic data. So let's use the data we have and get rid of the stock market and just focus on the economy so that we can get more information. Mariana tiene una pregunta aquí sobre el Rincón de Juana. Sí puedes inscribir para el Rincón de Juana, pero necesitas una suscripción de 1 año para Sectors Made Simple para entrar a estas clases. Si tienes una suscripción y necesitas el enlace, por favor envíanos un email a support@sectorsmadesimple.com y puedo ayudarte con el enlace. Let me just type that up. Este es nuestro correo electrónico. Por favor, envíanos un email allí. Gracias. All right. So let's look a little bit more in detail here at the economy and only the economy. Why use the market cycle to predict the economy when we can just use the economy to understand the economy? Cut out the middleman, right? But to do this, we need to talk bonds. And I'm not talking bonds as in like a family or marital bonds and all that. No, we're talking about economics here. And bonds are what's called a debt security. A bond is an IOU issued by a company, a state, the government, like the Fed. The US Treasury is one of the largest issuers of bonds, but so are companies. If a company wants to raise money for a project, what they might do is they might issue bonds. These IOUs that you give them $100 today, they pay you 5% interest for 10 years and then give you that $100 back. That is how a bond, in very simple terms, works. Now, how much interest they pay changes based on 2 main factors. The most obvious one is, like we mentioned earlier with banks giving you a loan, risk. What's the risk that you actually get your principal back? If you gave someone $100, what's the chances you get $100 back 10 years from now? But the second part of it is the duration of the bond. If I give you $100, I want more money if you're keeping my $100 for 10 years. Think about it like this. You give me $100. And I want that money for a year. Okay, you might charge me 5%, so $5 extra. That's fine. You gave me $100, so now you personally have $100 less, but you know in 1 year you'll get your $100 back plus $5 of interest. What if instead it was, I didn't want it for 1 year, I wanted it for 10 years. All of a sudden, you're giving me $100. You know, if I'm good on my promise, I will give you $100 back. But you don't get that $100 for 10 years instead of just 1 year. Of course, if you're losing $100 for a sheet of paper that says, I will pay you back in 2032, cough up some more money, all right? I'm not doing that for 5%. Give me 10%. That is part of how bonds work. One part of it is what's the risk that you don't pay me back, and the other is how long are you going to keep my money before I get it back from you. So the more risk, the longer the bond, or both, the higher the interest rates for that bond. So now that we understand what a bond is, what a bond interest rate is, and what parts go into what that rate really turns out to be, let's go look at two of these, one of each. One where the part that we care about is how long the bond is, and the other we care more about the risk of that bond being repaid. Because we can use both by looking at two different types of bonds. First, let's start low risk, and by low risk I mean near zero risk, but changing the length of that borrowed bond time. We're going to look at Uncle Sam and his wallet, known as the US Treasury. The US Treasury issues a lot of debt securities, or debt instruments as they're known, with different lengths. Some might be as short as 4 weeks, and others might be longer, up to 10 to 20 years. But the ones we're going to talk today about are Treasury notes and Treasury bills, called T-notes and T-bills, respectively. Now remember, as I said right before this, longer bonds means higher interest rate. I keep your money for longer, but you want more interest in return. Now, that's great if the economy is this very flat line of nothing ever changes. But that's not how reality works. In reality, we have periods where the economy slows down, periods where it speeds up, and these bonds change their rates over time, especially those shorter term bonds. So one way that many economists will track the risk of a recession is by looking at the difference in how much interest these rates pay. Mainly T-notes. So two different durations we're going to look at. The long term is going to be 10 years. The short term is going to be 2 years. And the warning sign, where the alarm bells start to go off saying a recession might be coming, is where the short-term yield goes above the long-term yield. That's really insane sounding, but let's break this down into some easy ways to understand it. 2012. Let's go 2014, sorry. I took out a T-note for 10 years. The economy was in a different place in 2014. So that rate, that interest that it would provide, was pretty different. And it was high because it's a 10-year security. I don't get my $100 back for 10 years, so darn it, I want some good interest. But there's low risk. It's the US government after all. Fast forward to today. I'm still 2 years away from collecting my 10-year note. But now there is a 2-year security. So I can buy an IOU that would mature in 2 years. Also, I feel like the mic's a little too loud. Let's try that. Let me know if I put it down too much. But what we end up with here is This shorter term bond, because of how crazy the economy is, asks for a much higher interest rate because there's a lot more economic risk involved. And also, that period of time is still long-ish. It's still long enough. So the warning sign here is where the 2-year note return, or as we'll call it, yield, goes above the 10-year. When those short-term bonds start to pay out more than those long-term bonds, something's changing, and in the past 50 years, this indicator has been perfect in predicting recessions. Or rather, every time we've had a recession, this rate went negative. This is what that chart looks like. Unfortunately, on the webinar, it might be a little tricky to see. Hopefully, it's just my screen and it comes up well for you, but I'll step through it. 1980, the Middle Eastern oil crisis. We saw the rate fluctuate quite a bit, but 2 different recessions happen in a 3-year period. Both times, we saw the 2-year outpace the 10-year. 1990, we saw a recession here occur, where we saw the rate drop below 0%, rise up once again, and in that rise, we saw that recession occur. Looking at the dot-com bubble in the early 2000s, the rate dropped in early 2000. Soon after, we had a recession. Leading up to the mortgage crisis in 2007 to 2009, we saw rates drop negative once again, and a recession. Even in the 2-month recession of 2020, we saw the rate dip its baby toe into negative territory, and a recession happened soon after. Currently, that rate is negative. So if all you looked at was this single chart, congratulations, we're going to be in a recession soon. But I promise you it's not as bad as it might seem. And to understand a bit more, let's add player 3. We're going to add another player into this chart. We have 10-year, super long term, 2-year, moderate term. Let's add 2-month, a short-term security. And this is what that chart looks like. Now, unfortunately, this chart only goes back to 2017. But let's look what happened in 2020 when that recession occurred. We saw a crossover where we had 2-year and 10-year, 2-year and 2-month outpace the 10-year. And then, after the recession, things evened out as they should. We should have 10-year above the 2-year above the 3-month. Now, again, we only saw for a couple of days the 2-year go above the 10-year. But there was a period of a few months that we saw the 3-month be above the 10-year. The real warning sign here is when all 3 of these rates are super close or the 10-year is far below the 2-year, which is below the 2-month. So let's look where we are today. Where we are today, we see 2-year above the 2-month, the 2-year above the 10-year. But far below that is the 3-month. So really, the question is, where do we sit with all of this? Well, according to the first chart, we're nearing a recession. The 2-year T-notes are above the 10-year. But that second graph shows another side of it. Because the 2-year or the 2-month is still far below the 2-year and the 10-year. If things were really, really bad, we would see that 2-month above the 2-year, above the 10-year. And we're not seeing that. We're still seeing 10-month or 2-month way below the 2-year and 10-year. But there's another side to all of this. Whenever I talk about this economic or market cycle, I try and remind people that there's a lot of other things that go into it. Seasonality matters. What month of the year will change what sectors will perform well. So when you're looking at sector rotation, it's not just the market cycle leading this. It's also seasonality. It's also overall trends in the market and overall trends in the world. There's so many different factors that go into sector leadership that aren't just market cycle. The same thing is true for the economic cycle. So economic downturn, this recession, might be part of the reason we'll see higher short-term yields. These interest rates where the 2 years above the 10-year. That happens historically where we have a recession in the near future. But there are other factors that go into this that don't include a recession. Namely, the federal funds rate. The Fed has this tool that they use to try and drive down inflation and repair the economy without plunging it into a recession, or trying to lessen the effects of a recession should we have one. Now, this Fed fund rate has seen some massive changes in the past year. In March, it was 0%, or near 0%. Right now, it's around 1.75%. Next week, the Fed meets again. We should expect to see it go up to 2.5%. And the Federal Reserve's estimates that they provided to us last month had them all estimating around 4% by the end of the year. That is incredibly aggressive. And these aggressive changes they have made because they believe, and I'm not just telling you they say, all of their predictions point to us avoiding a recession. They fully believe that we can avoid a recession entirely because of how aggressive they are trying to tackle this interest rate problem, or this inflation rate problem, by rising the interest rates. So it's hard for us to know how much of this bond yield change is due to the federal funds rate changing, and how much of it is a predictor of a looming recession. So to get more information, remember I told you nothing tells us the whole story. So let's move on and look at another piece of information so that we can get more context and another opinion. The Corporate Bond Market Distress Index. I'm not going to say that another time because that is so long and so confusing. I feel like I got thrown back into college and whacked over the head with a textbook when I started learning about this. But it is incredibly interesting and incredibly useful. So I'm going to avoid having to whack you all over the head with a textbook. We're going to call it the CMDI. So what is the CMDI? Well, we just looked at federal bonds, these federal debt securities that are issued by the U.S. Treasury. Let's now look at companies. Because I said before, companies can also issue bonds, and these company bonds can be sold to investors and then by investors to other investors. There is both primary bond markets where you buy the bond from the company, and then secondary bond markets where you buy a company bond from another investor. This is a very recent index. This only began to be tracked in June of 2022 by the New York Federal Reserve. And they dated it back though. We have data back to 2005 for the CMDI. And the goal of it is to track the initial pricing of bonds, so how much they're being sold for on the primary market, company to you. How many bonds are being issued? So how many companies are issuing new bonds? How many people are buying new issued bonds? And also secondary markets. How many people are selling bonds? How many people are buying bonds? And what's the prices? And how does the prices differ between second-hand market bonds and primary market bonds? If all of this is pretty crazy and you don't feel like understanding it, I don't blame you. Just think about it like this. We're going to look at the chart. The higher the index, the more distress there is. We can just leave it at that, all right? So with that said, let's go and take a look at the CMDI. And also, I'm not just going to give you all the CMDI because I'm just going to show a picture of it. There's the link to the actual New York Fed article or to the publication of where they publish the data. Because next week, we will get a new month worth of data. Because right now, the chart is as of June 24th of this year. Next week, we will get another month worth of data. Hence why I'm doing this webinar today. There's a lot happening in the next week that I want you to be aware of. And I want you to know, going into it, the context of why all of the information they share with us matters. And so you can also make your own opinions based on that information. Getting off my soapbox, getting back to the data. We see here two different periods of recessions. 2008 to 2009, and the 2 months in 2020. In both periods, we see three different parts here, by the way. Market, investment grade, and high yield markets. So we can track all three of these individually, but also as a group. Where if we see them moving as a group, there's something big happening in the economy. If we see one of them moving, it might be in a specific sector or a specific company class, but we should usually expect to see them all moving together, or if one veers away, the other two meet them or drop back together. So what we're seeing in 2008 to 2009 is a spike up to around 5 to 5.5, or sorry, 0.5 to 0.55. Through the recession, it spikes and peaks around 0.75, drops back down to normal, and this is the part I want you to look at here. Peaks in 2012, drops back down, peaks in 2016, for only investment grade, drops back down again, peaks in 2019, drops back down, big spike in 2020, quick recovery, and that leads us to where we are today. Where we are today, I'm not even going to say pretend, I'm just going to pull this up over here. Let's hide investment grade really quick. I said let's hide investment grade really quick. Chart, change, please. You're making me look silly. There we go. If all you saw was this, everything looks pretty normal. There is a slight uptick, but nothing outside of what we saw for normal variance in the late 2010s, and well below what we've seen in 2012 that didn't cause a US-based recession. So what gives? Does this mean that we are avoiding a recession, or that no recession is going to happen? Well, again, we don't know yet. As far as investment grade goes, it is elevated. It is pretty high, and it is higher than most normal years. The only periods that have been higher that weren't a recession or coming out of a recession was 2012 and 2016, and partially 2015. So distress is rising for corporate bonds, but it's been higher, much higher. So in that chart, we had our three different lines: market, investment grade, and high yield bonds. Historically, when we saw these two recessions begin, that distress index peaked around 0.6 to 0.7 for all three groups, not just one. And currently, the high yield and market sit around 0.22, while the investment grade is elevated at 0.36 and is increasing. Now, again, these are all increases compared to where they were at the beginning of the year, all around 0.1. So this does indicate that there's something going on. There are storm clouds on the horizon. But as I showed with numerous periods throughout the 2010s where no recession occurred, that this number can go up, and that doesn't immediately signal boom, recession. It is not as clear of a predictor of a recession as, for example, the treasury yield curve that we just talked about. But it is saying that something is happening. How severe it is, though, is yet to be determined, but is not an immediate cause for concern. So as far as I'm concerned with this, there is risk, but there's also a decent chance that recessions are avoided and that we are able to move past this without actually dipping into a real recession. The last thing, break-even inflation. This one is one of the more tricky ones to understand, but I want to go through kind of what it tells us, and then, again, pictures are worth 1,000 words. So we'll go and look at the graph for this break-even inflation rate. We've explained earlier today that inflation rates change throughout the cycle. And we just talked about bonds that offer a fixed interest rate over its period of life. Another fancy name for it is constant maturity. The rate is always constant throughout its maturity. It's your fixed rate loans, let's call it. But there's also things that are variable rate loans. Those variable rate loans, you might get a slightly better rate at first, but it always comes with the risk that it changes in the future. It either goes up or down in the future. The government also issues these. They issue variable rate securities known as TIPS, Treasury Inflation Protected Securities. And these TIPS are meant to be a changing yield, where the amount that they pay out changes based on current inflation rates. So when there's higher inflation, they give you higher return. And now we have two different things. One that is stable. It is the flat line throughout its entire life. Then we've got the wild child that changes its opinion depending on the weather. If the economic atmosphere is crazy and inflation's high, it'll pay out higher rates. And now we have a way of comparing the two, because both are interest rates. One's interest rate changes, the other one's is steady, but changes depending on when the bond was issued. So what we can do is compare the yields of these two securities, what the interest rates are. And we can do this by looking at, again, we always want to look apples to apples here. We want to be fair. So what we'll do is we'll look at 5-year Treasury Inflation Protected Securities, or TIPS, and 5-year bonds, T-notes. Then we'll also look at 10-year. So 10-year T-notes, 10-year TIPS. And we'll compare the return between the two, and we'll graph them on what is called the break-even inflation rate. Once again, if all of this is crazy to you, let's look at the chart, and we'll get a lot of information out of the chart. If you're wondering where this data comes from, this data comes from the St. Louis Federal Reserve. They are the ones that have been tracking the break-even inflation rate. And also they have a very funny name for it. They call it Fred. So let's see what Fred has to say, shall we? What Fred says is, if we look back in time, once again, the gray bands are periods of recessions in the past. What we have is, in 2008, in the middle of the recession, the rate plunged and went negative. Then went back up. And again, what this rate is this is what the rate of inflation has to be for a 5-year tip to return the same as a 5-year fixed rate security. So the inflation rate went negative for where that break-even point was. Then went back up. Keep in mind, the Federal Reserve's goal is to keep inflation around 2 to 3%. So when we see 2 to 3% here, that's on the high end of where we should be. In reality, we want it to be below 2%. That should be the normal range. So we get back to normal by 2010, kind of live normal. Boom, 2020 happens. It drops once again and has been climbing ever since until February of this year, where that rate started to dip once again. Okay, that's cool. But what I see here when I'm looking at this is to me, signs of a correction, not of a crash. In the past, we've seen a rapid plummet when these rates drop during a recession. But also, we see these rates crash in the middle of the recession, not at the beginning. So this isn't so much a leading indicator of a recession, so much as it is a way of us knowing, are we in a recession today? Let's look at 10 years. Where 10 years, similar story. We see the rates drop pretty significantly in periods of recessions, with the rate hovering somewhere between 1.5 to 2.5% throughout its lifetime. Once again, we are seeing a drop here, but not a crash. So what do these break-even points tell us? What they tell us is that the break-even inflation rate is decreasing quite a bit. But it's not exactly at worrying levels just yet. It is dropping but not crashing. We still have both our 5 and 10-year rates well above the historical average. Also, before I go too far, let me give you all the links. There's the 5-year and there's the 10-year. Thank you, St. Louis Fed, for that data. So what we're finding is that we are still above the historical average of where we should see these rates. And we very well just could see these rates become normal again. But there's one part that these charts don't show that I wanted to highlight. The real problem here is not... Kira, can you do me a favor really quick? Can you grab a rubber band, please? Thank you. There should be one in the drawer with the back clips. Yeah. You'll see why in a second. The real problem here is not when we have a crashing rate. The real danger is where we get a current inflation rate that is significantly different than our current interest rate. And to show an example of this, I'm going to use a rubber band. The break-even rate is currently around 2.3 to 2.5%. The US inflation rate is at 9.1%. I have a rubber band here. This rubber band is that 2.5%. What happens if it gets super, super far? It snaps. Let me put it a little closer to the mic. There's a big snap. If I have it a little lower, just not as much. If it's a big change, there's a bigger snap. That bigger snap can happen in a recession. And that bigger snap could be the beginning or the indications of the beginning of a recession. So the real value in this indicator is not where the current value is today. It's how different that current value is to our inflation rate. And that difference is almost 7%. That is the cause for worry here, is not in the current rate. It's in the difference between the rate and inflation. Something has to drop that inflation rate. And there's two things that can do it: a recession or the Fed. So I'm sorry that I didn't get to come today and bring you all a bunch of amazing news about, oh, we're completely fine, we're avoiding a recession. I don't control the economy. I'll tell you who does: the Fed. They have the power to help us avoid a recession. And they are still optimistic that they can do so. So where does that leave us as US citizens, US people that live here, and investors? Well, many signs point to us not currently being in a recession, although some point to us leading into a recession. Bond yield curves, this idea that bond rates will change between 2 months, 2 years, and 10 years, indicate a looming recession, but part of that might be due to the Fed's quick changes to the federal funds rate. Corporate bonds are split. We see investment grade securities or investment rate bonds going up in distress, while the rest are sitting elevated but not danger levels of high. And lastly, the break-even inflation rate are returning back to a normal value, but the real cause for concern is that rubber band effect of what happens when we have a rate of inflation far different than the break-even rate. And this leaves us with quite a few mixed signals of not knowing what's happening, but wanting something to follow to understand what we should see in the near future. So the question remains, what can the Federal Reserve do to help us mitigate a recession, and at what cost? So I can't answer that last part, but what I can answer is that first part. What can we do? Well, as investors and US residents, we can continue to follow the Federal Reserve's movements. We can understand and follow what they are doing and the numbers that they are publishing, as well as we can follow earnings reports for companies. We are leading into Q2 earnings season, and many of our Sectors Made Simple newsletter What to Watch For sections will be the upcoming earnings reports for that week. And lastly, we will get GDP Q2 numbers this week. So that is going to be another very valuable piece of information as we start to figure out, are we in a recession or are we heading into one? So some dates for you all. The Fed has their next meeting on Tuesday and Wednesday of next week, July 26th and 27th, where they will likely raise the federal funds rate again. Estimates are currently saying 0.75%. On Thursday, the BEA, or Bureau of Economic Analysis, will announce their first estimates for Q2 2022 GDP, and that, if it's negative, would be a second consecutive quarter of GDP losses, the very textbook definition of a recession. And lastly, as investors, we must remain confident that there is a lot of room and time for recovery, and that growth does not require a recession to take place. It can be avoided, but it is not easy. And should a recession occur, remain confident and take some comfort in knowing that bull markets often begin in the middle of a recession. The market cycle precedes the economic cycle, and that we always rise to new highs in the future. So that is where we are today. That is some dates and events to take note of and keep an eye on next week, and some optimism and silver linings that we should understand for the future. So, we discussed a lot today, and a lot of these were very new ideas. So if you have any questions or would like any more information, please feel free to send us an email at support@sectorsmadesimple.com. If this kind of analysis, looking at the stock market and the economy through data, is interesting to you, consider checking out a subscription for Sectors Made Simple. I do lots more of these kinds of analyses in our members' webinars using the different tools that we have available to us through Sectors Made Simple. And if you are just getting started and all of this is still crazy to you and you want to start from the beginning, we have our Figuring Out Finance webinar series right now, which takes you or anyone. Mostly this is aimed at younger students, but anyone that wants to get their financial journey started off on the right foot, this is the place for you to start learning. These classes are done live. They are done by me and my mom, Julie Stav, and registrations are still open for that if you'd like to join us for Monday's live class. There's a link to the registration in the chat, as well as it will be in the resources section. But that's all the time we have for today, everyone. So thank you all so much for joining us. Keep in touch, follow the market, and we'll be back next Friday to see how everything shakes out. So thank you all so much. Take care.